Hello, everybody, and let me be the first to wish you a happy Thanksgiving. We have so much to be thankful for in this country and with our families and with our health, the blessings that we have. And we just want to extend our thankfulness to all of you for being clients of our firm. Today, I have my sidekick financial advisor, Jessica Kinnunen, with me, and our lead portfolio manager, Bob Key. And our goal today in the few minutes that we have with you is just to discuss what's been going on the last few years. And so Bob has designed a chart, and we're going to go through it periodically over what's happened over the last 4 or 5 years. So Jess, if you can put that up and get us started.
Absolutely. All right. Can you see that okay, guys?
Yeah.
Perfect. All right. So you can see here, January 2019, everything was kind of going along as it should. You know, stocks were going up. We had a nice bull market going up. And then you can see January 2020, COVID hit and everything broke loose.
And it's funny when that hit, because when it did hit, I don't think anybody believed it was coming to the United States. We thought it was contained to Asia. Ironically, back then, Bob and I were making the call to get our money out of Asia right then and there. And within a day or two, we also pulled all of client money out of Europe as well. But I don't think any of us saw a full shutdown in the US coming, and we were wrong. It did happen, and it happened abruptly. And you can see by the chart, we had our bear market COVID recession where stocks went down 33%. And I vividly remember that because Bob and I would talk almost every day on the phone. I'd be out for a walk because there was nothing else that I could do. I was kind of going nuts. Bob was going stir crazy as well. And we were just trying to make sense of things. You know, obviously, we were going by the headlines, we're going by whatever news the government put out. And we were really at a loss because we had never been through a pandemic before. Bob, you remember those days?
I remember them well, and what I remember most about them is like all human beings, there's the initial anxiety that comes with uncertainty, and you and I were discussing at great length. Needless to say, there's no historical context to put what happens when we have a pandemic and what happens to financial markets. So, as we started to get a little bit in that trap of what's going to happen with this pandemic, we realized, our process is we don't trade or invest off of headlines. We trade and invest off the economic data. So what does this mean for the economy? Well, the first thing we came up with is if they're shutting the economy down, that's bad for the economy. That's going to cause a deep recession. But it was quickly after that we realized the amount of liquidity they said they're going to inject the economy with is ultimately going to be extremely positive for the economy. We recognize we don't know when this, they're going to turn the economy back on, so to speak. But when it does, the thing should soar. And that's why, after initially, doing the cautious piece of moving out of international securities into domestic securities, we did not make the grave mistake that so many people made of removing our equity exposure whilst these stocks were down. To the contrary, we got slightly more aggressive, although we didn't know where this bottom would be. We were relatively certain that it would ultimately be positive when they turn this economy back on, and that's exactly what happened. We got 100% rally off of the bottom from March of 20 to January of 2022. Now, when you put $8 trillion worth of liquidity into the economy and send people checks, needless to say, that's also inflationary. So inflation started to creep in, the Fed started talking, and we peaked in January, basically the first day of January 2022, and promptly had about a 25% sell-off and a recession.
Right. And so why did it drop so much? Well, probably because the feds were talking, right? And the feds also decided to go ahead and put forth what they were doing. And so it was like, it's unfortunate that they started talking so quickly, but the markets reacted so quickly as well. And so you have that big drop, and we thought it was going to be, better than it was. But, now we see it went down to October of 2022. And we're seeing it bounce back up now, Bruce.
Yes, that recession that happened last year, by the way, it didn't happen. It was a bear market, but this recession was predicted over and over and over. And many of you would call in with questions about, are we in a recession? Are we going to have a recession? And no, it was a bear market. The recession never happened. Employment continued to improve in the United States. And then from about 13 months ago to last August, we ended up in a rally again, a bull market. Notice a 28% move from the middle of October last year until the middle of August this year. And I think it was a really unappreciated rally. And unfortunately, with your statements, our statements come out quarterly, and you didn't get to see all of it because September ended up being quite a stinker in the market. And that's where I'm going to have Bob bring this in for a landing now, because we did have a correction, but look at the long term, Bob.
Yeah, and that's where we want to get back to. I've never liked the expression, well, you just have to wait for stocks to come around again. That I don't like that expression. I do like the expression that history repeats itself, and our process is predicated on the relationship between economic variables and financial market prices, always return to their equilibrium. So right now, as we look at markets, they're only about 6% off of their all-time highs. Our call was for them to approach all-time highs by this year end and to make new all-time highs in 2024. That's because Q3 earnings have just finished up. Q3 corporate earnings are at all-time highs. They made all new all-time highs. Stock markets are not at all-time highs. Therefore, if earnings are at all-time highs and stock prices, the most important thing to stock prices are their corporate earnings, that means that stocks are now a better value than they were previously at their all-time highs. But more importantly than just earnings being at all-time highs, they are expected to grow again in 2024. There's no reason not to expect stocks to continue growing in 2024. So what this red line shows on the chart is, for all the craziness, right? If we kind of go back to pre-COVID and we draw a line to where we are now, the trend is still there. The stocks are doing what they're supposed to be doing. They're averaging about 8% a year. That is what you would consider to be trend returns in the stock market. So we always need to overweight, underweight, and adjust depending on what the economic variables of financial markets are. But again, looking at economic variables, understanding the relationship between those variables and financial markets has always proven to be true. Doesn't, we, at some level, we wish we could eliminate the craziness that goes on between, but sticking to long-term plans, once again, has proven to be an extremely effective investment strategy.
I want to just add to you what you said, Bob, on that, and that is that 8% annualized return over the last 4 years. That's including a 33% correction for the COVID recession. And that's including the 25% bear market last year. So we've had 2 huge bear markets in the last 4 years. And despite that, we've averaged 8% a year on the S&P 500. I think it gets lost by people. And so I wanted to make sure we reiterate that. How about the crystal ball? 2024. What do you got?
Ball 2024. Can I predict something that's already happened? I predict inflation numbers are going to become below expectations. And that's obviously been our thesis. We've talked a lot about why that is our thesis. If we take a look at globalization and technology, they are incredibly deflationary forces. It is why we believe the Fed has overly tightened. They've spent a decade and a half trying to fight against deflation or inflation being too low. The ridiculous amounts of liquidity that were injected into this economy finally got a little, and shutting the economy down, so we stopped supply chains, finally got some inflation. But it is, the argument is that transitory is persistent, and it is, as we're seeing, it is clearly transitory. It is disappearing again. We expect inflation to continue to fall. I think by the end of 2024, we could have headline inflation back down to 2%. We will quite possibly have the Fed cutting interest rates again as they get concerned over inflation dropping too much. There are no signs of recession out there. right now. Of course, we're continuing to monitor things. A little bit of a tidbit. I think it's amazing with the the war that's going on in the Middle East. We've seen oil prices actually drop down to the 70s right now. Oil production soared during this period. Consumers have a lot more elasticity of demand now that they can, this new post-COVID world of Zooming and all that, but they can just cut down the demand. The biggest threat out there continues to be real estate, in particular commercial real estate. If rates continue to stay where they are or drop, we think real estate will be fine. If rates, for whatever reason, do continue to rise, that is an area we have to be very, very cautious of.
As always, we want to thank all of you for taking time to watch our video posting today, but we'll always leave it open to questions. If you'd like to talk to Jessica or myself, please shoot us an email, give us a call. We'll get back to you right away. If it's something super technical, we'll bring Bob in. But in closing, Jessica, where are you gonna spend Thanksgiving?
We're going to spend Thanksgiving at our farm in Wisconsin.
Great. And
Good
how about you,
old-fashioned.
Bob?
I'll be fleeing to the south in the warmer weather of South Carolina.
I will be in a different spot in South Carolina, but doing the same thing. We don't all want to be in the same spot because there's too much risk if all three of us are in the same spot. So we're spread out. We're geographically diverse.
Right.
Happy Thanksgiving to all of you. And again, thank you for your business, and we'll talk again real soon. Bye-bye.
Thanksgiving, everyone.